All right, well, thank you everybody for joining us here today. My name is Scott Garr. I'm the Dean at the College of Business here at Mississippi State University, and this is one of my favorite events that we do each year. So I'm quickly going to turn it over to Professor Tom Miller. He holds the Jack R. Lee Chair in Financial Institutions and Consumer Finance here at Mississippi State University. I also want to thank Mr. Frank Lee, who's here in the room. Through the Lee Chair, we are able to bring speakers to campus who can help us push the way that we think in terms of law, economics, finance, regulatory policy. But this is how knowledge gets created. It's by pushing the envelope and forcing us to think a little bit differently. I know nobody here came to see me drone on and on about my thoughts, so I'm going to turn it quickly over to Tom Miller, who's going to moderate today's event. Tom, the floor is yours.
Oh, thank you, Dean Garr. So welcome everybody. My name is Tom Miller. As Dean Garr said, I'm a professor of finance here at Mississippi State and the inaugural holder of the Jack R. Lee Chair in Financial Institutions and Consumer Finance. Through the Lee Chair, we welcome distinguished thinkers to Mississippi State, and they discuss research and current events at the crossroads of law, economics, finance, and regulatory policy. For the live stream folks, if you have any questions, please feel free to comment below, and when we get to the Q&A session, we'll try to work some of those questions in. So when I kick off here, I'd like to thank Mr. Frank Lee as well. He's a distinguished state alum. He's helped me plan, host, and enjoy the Lee Speaker Series since 2012, so it's been a while that we've done this. So, excuse me. Last year, we were joined by Mr. Brian Johnson, a former Deputy Director of the Consumer Financial Protection Bureau. That event and the two previous ones are available on my page at the website of Consumers Research. Today, we are delving into the world of the overarching approach to federal regulation, which in many circles is a contentious arena. As customary in our series, lurking in the background is the question of whether consumers are better off and best protected through the centuries-old process of market innovation or through rigorous regulatory oversight, or possibly a combination of both. So now I'll turn to our guest. We want to hear from him, not from me. And I'll briefly list some of his many career accomplishments. And so if I did them all, it would fill up our entire time. But Mike Faulkender is currently the Dean's Professor of Finance at the University of Maryland Smith School of Business. He's also the Vice Chair for the Center for American Prosperity and Chief Economist at the America First Policy Institute. Previously, Dr. Faulkender served as the Assistant Secretary for Economic Policy at the U.S. Department of the Treasury. In that role, he advised the Secretary on domestic and international economic issues. Of note, during the COVID-19 pandemic, he assisted in negotiating the CARES Act and was a senior Treasury official who led the implementation of the Paycheck Protection Program. He received the Alexander Hamilton Award from the Department of Treasury, which is, the Alexander Hamilton Award for Distinguished Leadership. It's the highest service award granted at the Department of Treasury. I will add that I didn't put this in my written remarks, but I didn't know until Dr. Faulkender was confirmed by the Senate that when you're confirmed by the Senate, you have the title of the Honorable. So the Honorable Dr. Faulkender has an impressive academic vita. His work has been published at the very top levels of academic finance journals, primarily does research in public policy, corporate capital structure, risk management, corporate liquidity, and executive compensation. He's been cited often in the Wall Street Journal, the Washington Post, the New York Times, among others, and frequently appears on TV and podcasts. At the University of Maryland, he teaches classes still in the MBA program and the EMBA program. Previously, he served on the faculty at the Wharton School at the University of Pennsylvania, Northwestern University, and the Olin School at Washington University in St. Louis. His undergraduate degree is in managerial economics from the University of California, Davis, and he earned his PhD in finance from Northwestern University. It is my personal distinct honor and privilege to have been able to work directly with Mike at the very beginning of his academic career, and through the years I've learned much from him. He has my utmost respect. So please join me in a hearty bulldog welcome to our guest. saying is our focus is on discussion is on the overarching regulatory approach during the Trump administration, lessons learned from it, and the potential approach if there is a second Trump administration. Then I'll ask a few specific questions about Dr. Faulkender's role when he served as Assistant Secretary of the Treasury. Then we'll have a short Q&A session with our live participants and those attending online. Those questions will be asked by Mr. Bo Brunson of Consumers Research. So, without further ado, when I was trying to come up with a list of questions, I was talking to some of our faculty members, and Dr. Brian Blank says, you know, I have a burning question. How in the world, and this is my burning question too, tell us how you became the Assistant Secretary of the U.S. Treasury, a Senate-confirmed role, having never held any federal government position, and to my knowledge, no government position, unless you count being a professor at a state school as a government position, but anyway, be that as it may. So please tell us your story.
Well, first let me say thank you for inviting me. It's great to be here. Thank you for those of you that are attending in person and participating online. You know, I followed a kind of normal academic career. Got my PhD, took my first job at Washington University in St. Louis. I had Tom right across the hall from me, so I learned a lot from Tom entering into this profession, how to navigate it. You know, and the path when you're starting out in an academic career is pretty straightforward. It's the standard publish or perish. It's, you know, generate for yourself an intellectual thought leadership role in the profession, build up a body of knowledge that you have created from which you can then expand into doing other things. And so I became a tenured professor, full professor, and eventually got called in to serve in the dean's office. But part of why I moved to the University of Maryland in 2008 is because, as you mentioned, a lot of my research is at the intersection of finance and public policy. So, you know, for those of you that are thinking about getting into academic careers, you know, you're looking for and having an opportunity to go to the university, many people don't know, is 8 miles from the nation's capital. We are inside the DC Beltway. We are not in Baltimore. We're not in Annapolis. We are right inside the Beltway. And so being able to interact with policymakers and get some insight from the way that they were thinking about things as they're implementing changes in regulatory policy or tax policy is helpful. And also being able to take the work that I was doing and explain it to policymakers because it was very much of interest. And so I started attending not only your traditional academic seminars and conferences, but having an opportunity to attend policy events around Washington, D.C., right? So we have think tanks, we have conferences, and they're geared not just towards your traditional academic audience, but they bring in practitioners, policymakers, congressional staff. And so I was able to build some relationships. And one of the people I got to know at a number of these events had served as the Assistant Secretary for Economic Policy during the Bush administration. And I had said to him, you know, if ever out, I wouldn't mind to take leaves or take sabbaticals and serve in government. And I very much believe in that we should have a government that has people come in, temporarily take on leadership roles, and then return and live under the rules and laws and policies that they implement. And the opportunity to take a break from my academic career and go in and be on the other side of the curtain and see how policymaking works was something I would be interested in. One of the papers that I worked on at one point in my career was with somebody who served as the chief economist at the Securities and Exchange Commission. So this idea that there are departments and agencies in the federal government that have people come in from academia and serve in an economic role, advising senior policymakers was really fascinating and something that I would be interested in doing if the right role came out. Now, ultimately in 2017, I stepped in to become the Associate Dean of Master's Programs and was overseeing the MBA programs and the specialty master's programs, and I was literally in a late September morning sitting in an MBA curriculum committee meeting, and I got an email from that friend who had served as assistant secretary and said, the Treasury Department asked me for names of people who might serve in the role that I used to have, and I gave them your name, so expect that you're going to be receiving some outreach. And I remember thinking, wow, that, rather than sitting in an MBA curriculum committee meeting, that might be a fun thing to do. And very quickly I was asked to come down and interview with the undersecretary for. Oh, and by the way, that person who was the assistant secretary, he's now the director of the Congressional Budget Office, Phil Schwagel. So, great friend to have, somebody that I still talk to on a regular basis. My first interview at Treasury was with David Malpass, the Undersecretary of International Affairs at the time. He went on to become the president of the World Bank. My second interview was with Secretary Mnuchin, and after that, and so I remember I was in an Uber from the Treasury building back to the university after the interview with Secretary Mnuchin, and the White House liaison, the person who is in Treasury that works at the White House on positions that require presidential appointment and Senate confirmation, calls me and says, that went really well, we'd like to forward your name to the White House. And again, reiterating that this was my first tour through this and I had never done anything like it, I foolishly, of course, say, that's great, what does that mean? And he responds, well, we only forward one name. I said, oh, you just offered me the job. This is great. So so I went through the FBI background check, the ethics review and crafting an ethics agreement, was nominated by the White House in March of 2018, went through the Senate confirmation process, came on board in 2019.
And how long did it take to get Senate confirmation?
Well,
Time.
again, kind of demonstrating the extent to which Washington is a little bit broken. I ended up going in first as a deputy assistant secretary. So even though I had been nominated to be assistant secretary, it was taking so long to get through the confirmation process that they brought me in one level lower as a deputy assistant secretary, because that does not require Senate confirmation, while I awaited confirmation. But on the day that I was confirmed, I went into Excel because I didn't want to count the days myself. I put in the day I was nominated by the White House, put in the day that I was confirmed, and just took the difference between them, and the number was 500. So it was February of 2018 when I was nominated, August 1st of 2019 when I was ultimately confirmed and sworn in. That's not because I was a terribly controversial nominee. I was voted out of committee 25-2, and I was voice vote on the floor, which means it was so overwhelming that they didn't even need to do a roll call vote. So.
Wow. Okay. And then you've stepped back to the University of Maryland.
And then at the end of the administration, as a political appointee, I tendered my resignation at the end of the administration and returned to the university.
Okay. And then stepped into your role as chief economist at the AFPI.
Right. So then in 2021, many of the people that had served in the administration were looking to put together a think tank where a lot of the policy work that we had done, there was very much a sense that we were not done with the work that we had started during the first term. So there was a desire to see the work that we had started during the first term continue, and that there be a mechanism to continue researching and educating the public and policymakers about the successes that we realized during the first term. And so AFPI was created in early 2021. I originally came on as a visiting fellow. So I was still at the university, but then I was doing some contributions on some of the work they were doing. They liked the work that I was doing, such that in October of 22, I was promoted to chief economist. And then earlier this year, I was also named vice chair of our center. So Larry Kudlow is the chair of our center, and I'm his vice chair.
Terrific. So let's, since you mentioned the policy work that you had started in the first administration, can you give us a sense of the overarching regulatory approach that was taken in the first Trump administration and its subsequent effect on the U.S. economy, if any?
Sure. So, you think about that Congress passes laws, but then there are administrative departments and agencies in the executive branch that then craft the rules and implement and enforce the rules that accompany the law. So Congress will draft something rather generic, but then it will be left to the departments and agencies to write the detailed rules that actually implement the law. And so you can think about a number of those rules were issued decades ago and probably made sense at the time that they were enacted, but there is no standard process whereby rules have an end date on them, right? There is often no sunset provision in them, nor is there a standard mechanism for reviewing them. And a rule that, again, may have satisfied a cost-benefit analysis at the time of its enactment doesn't mean that in the current economic environment that it still makes sense, or that it appropriately balances the costs and benefits to the economy of that particular approach. And so President Trump came in and said, you know, we need to be reviewing these rules, and we will find in many cases that they no longer make sense, that they no longer should be in force. And so he set out a rule, he set out an executive order early in his term that for every new rule enacted, a department or an agency had to come up with 2 rules that they were eliminating. And prior to COVID, I believe we actually were not at a 2-to-1 ratio, we were at an 8-to-1 ratio. And so there was very much, with leadership coming from the White House, a very strict objective to go take a look at these rules that were stifling the American people. And just to give you guys a sense, because I don't think most people understand just how onerous the rules are. The National Association for Manufacturing, who of course monitors all of the rules that are implemented that have an impact on manufacturing, estimates that all of the rules and regulations of the federal government create $3 trillion of economic cost just in the manufacturing space. So these, you know, in addition to a deregulatory approach that we took during the Trump administration, of course, the president often says that tax reform was another major economic initiative, and that's what gets a lot of public praise. But if you really talk to the president, he will tell you that the deregulatory activities that we engaged in probably had contributed just as much to the economic prosperity that we realized during the Trump administration as did the tax reform that we implemented. That's kind of the scale of the impact. So it was very much an idea that we need to reassess the burden that's being placed on the private sector. Okay, because again, for those of you that are not, you know, students of economics, let's go back to the very basics, right? The private sector is what serves the vast needs of the American people. The government does not build houses, the government does not build cars, the government does not generate electricity, the government does not grow food, the government does not sew clothes, right? So if you go kind of just the basic needs of the American people, the vast majority of your basic needs are fulfilled by the private sector. The role of the government is to provide a playing field and provide rules. Now, you know, they also provide roads and engage in national defense, and there is some economic redistribution of resources that goes on, given that people have different outcomes in life and are different life cycles. But for the most part, the needs of society are met by the private sector. And so when we impose requirements or restrictions upon them, you potentially deter them from generating as much quantity of goods and services as they otherwise would at a price that the American people can afford. And so you want to go through and to the extent that a rule no longer makes sense, to the extent that the economy has evolved, or more importantly, to the extent that the market fixes it itself, right? The single greatest regulator, quite frankly, you know, the way that an economics professor would teach it, is not the government, it's competition, right? If you've got many producers that are competing to provide that good or service to the private sector, to consumers, then that competition will in many cases curtail any potential negative behavior. Government comes in when perhaps there is some kind of market failure. But again, economies evolve, and so where we maybe needed government previously, we don't necessarily continue to need it in the same capacity today. And so we need to re-examine those things and really ask the question, are we actually achieving improvements in consumer benefit? Are we making the American people better off? Or are we just generating billions, if not trillions of dollars in compliance costs that actually don't produce a single good, generate an additional service, or lower the cost of anything that we're providing?
So when you reduce all those regulatory burdens, can you just give us a sense of what do you think the impact was on the GDP growth?
Right, so in 2019, the Council of Economic Advisors. So this is the group of economists that are part of the Executive Office of the President. Many of them are academics who take 1 or 2 year leaves from their academic institution, come and serve in the White House. The Council of Economic Advisors put together a chapter in what's called the Economic Report of the President. So on an annual basis, as required by law, the White House and the Council of Economic Advisors puts out a multi-hundred-page report on how's the economy doing. And so in that year, they put out an entire chapter on deregulation. It was primarily authored by Casey Mulligan, an economist at the University of Chicago, who was on leave at the CEA at the time. And they estimate that merely by not continuing to add regulation at the pace of previous administrations, that by itself was adding about a 1/4 point a year to GDP growth. And then on top of that, the regulations that we're reducing were adding a couple more points to it. So we were probably running 0.4% per year faster GDP, according to this report, than we previously were running. So that by itself, right? And remember, the base on this, just to normalize that number, CBO projects that real GDP growth is on the 1.8% range. That's the forecast for the next 10 years, is the 1.8 to 2% range, right? So if you take that 1.8 to 2 and instead you raise it to 2.2, 2.3, 2.4, that's a 25% increase in economic growth, right? So a 0.4 percentage point growth doesn't sound like a lot, but on a base of 2, that's a lot. And then if you can compound that and realize that every year for years, if not a decade, that's a significant improvement in the lives of the American people. And again, if you go back 30-ish years, around the time that Europe established the European Monetary Union, the size of the European economy, the size of the US economy were basically on par with each other. But the US has realized greater growth than Europe, such that the US GDP is about 20% higher today than in Europe. And again, how much of that comes from, we have a different incentive structure, we have a different regulatory environment, we have a different tax structure in this country. And so, over the course of a couple decades, we have a 20% difference in the size of our economies. And those are probably a reasonable comparison, continental Europe against us 30 years ago versus today.
Okay, so let's just shift gears a little bit. Like any businessman, businessmen that are in attendance can agree that they don't always pick the right path at the start. Maybe they look back and say, gee, we maybe could have done something different. My guess would be that President Trump would say if he has another opportunity, he'll be doing some things different. So there had to be some lessons learned from the first administration to a potential second administration. What do you think those lessons learned are?
So there have been a lot of lessons learned. I think my first example I'll give, I'll stay in the regulatory space.
Okay.
So as I mentioned before, the president said in an executive order a goal of removing 2 regulations for every new one enacted. Now, there are some rules out there that are decades old that are hardly even enforced, and essentially that are almost irrelevant. But you could have a department or an agency kind of check the box and say, yeah, we provided 2, but they have almost no economic meaning. So if you're putting in a new rule that's going to cost $1 billion, and you're taking out 2 rules that are essentially irrelevant because they're not even enforced, you're still adding to the regulatory burden that's being incurred on the private sector. And so I think one of the things that's been discussed, and that we have, so at AFPI, we have made a number of recommendations to an incoming America First administration. And one of them would be to shift from a number of rules metric to a dollar amount metric. So rather than it being for every rule you enact, you need to take out 2 rules. It should be, if you're putting in place a rule that's going to have $500 million of impact, well, then you ought to be removing, name your number. Is it $1 billion in impact, $2 billion in impact? We ought to be thinking about this ratio in terms of dollar impact on the economy rather than just in the number of rules, right?
Sure.
Now another piece is that I think we did a pretty good job during the Trump administration of really implementing a stringent cost-benefit analysis, but that's something that was, a lot of the lessons learned were it took too much time to get certain things up and running. There was some learning by doing, because you're bringing in somebody to the presidency who had not previously served in government, right? We're not talking about me, we're talking about President Trump, right? And so there were some things that I think he learned that he would do differently, and so I think we're gonna be, I think that the next, assuming that the president is elected in 2 weeks, I think you're gonna see a much more aggressive approach towards getting people in place faster, getting processes up and running faster, so that rather than kind of losing that first year, which I think many people look at 2017 is it took too long to get things up and running. I think you're gonna see a second term up and running exceptionally quickly, and I think you see that now. So when President Trump ran in 2016, he brought in Chris Christie to lead his transition process, and upon election, fired Chris Christie, and almost all of that transition work was lost. And so there was very little for people coming into the incoming departments and agencies to really work off of or much direction. Whereas President Trump has named 2 people to lead his transition team. One of them is Linda McMahon, who for the last few years has been the chairman of the board at AFPI and has taken a lot of the work that we have done at AFPI. We at AFPI have submitted that to the formal transition team, and I think you're going to see the transition team use a lot of it so that there are very clear directions on day one so that not a single day is lost. The way people put it to me is there are, let me remind myself of the math. There are 1,361 days in a 4-year administration, and we don't want to waste a single one of them.
Okay, very good. So, excuse me. So, let's go into the weeds a little bit here.
I did the math wrong. 1,461.
Yeah, right.
So.
But it's smaller than you think, really.
Yeah.
Yes. So.
And it is limited because we know
right.
that the president can't run for re-election.
Exactly.
So it is 1,461 days.
Exactly. So let's talk about something that maybe confuses a lot of Americans out there, and that is let's talk about the CARES Act of 2020 and the American Rescue Plan of 2021. Each of them was about a $2 trillion stimulus. And so what's the difference between them, and what effects did they have on the U.S. economy?
Right. So for those of you that don't follow legislation closely, the CARES Act was the legislation that was enacted in March of 2020 at the depths of the pandemic. So as you know, I don't know how much you guys remember exact dates, but we started shutting down the economy, and I think the president declared a national emergency on about March 15th of 2020. Now, at the beginning of March, a team was assembled. So you already had the public health team. They started in February of 2020. But there was a separate team created in March of 2020 to start thinking about the economic implications. And I was asked by the secretary to be the Treasury representative to this working group in the White House that was being led by the National Economic Council to formulate a plan that the administration was going to submit to Congress to how to address some of the economic implications. And that eventually became the CARES Act. So we had 7 work streams in that plan. 5 of them ended up going into the CARES Act. And that was the plan that Secretary Mnuchin led on the negotiations on behalf of the administration with primarily the Senate. And there, as I said, there were 5 titles within it, and the secretary asked me to be part of the team that negotiated the small business title. So the primary portion of that was the Paycheck Protection Program, which then after the law was enacted, the secretary asked me to take the lead on the implementation of that component of it, okay? But when we were designing it, the recognition was that we were going to be having literally tens of millions, potentially 100 million people in the United States stop working. And that was going to create a massive gap in their capacity to fund their everyday expenses. Because even if we shut down the economy, that doesn't mean that people don't have to work or use electricity or pay their mortgage or pay their car payment. So the basic bills were going to continue. And remember, for better or worse, about 40% of the American public doesn't have an additional $400 to incur a shock. And so if we had a massive disruption in income First of all, that was going to put enormous strain on the state-based unemployment insurance system. These are systems that, I don't know about the registration system at Mississippi State University, but I can tell you that the registration system at the University of Maryland is based on COBOL, a language that nobody alive today can still program in. Well, that also runs most state-based unemployment insurance systems. The words expandable and versatile don't really apply to these technologies. And so the idea that, and just to put it in context, prior to the pandemic, in an average week, okay, 200,000 Americans apply for first-time unemployment insurance, right? There's just turnover in the economy. People lose their jobs, businesses close, it's just not the right employee-employer match. Companies move locations. Layoffs happen. Average week, 200,000. The week the president signed the CARES Act, 6 million. Right? Again, to put that number in context, the worst week of the global financial crisis, which we thought was a cataclysmic event for those of us, my age and younger, the worst week was about 750,000. The week the president signed the CARES Act was 6 million. These systems, and by the way, the Obama administration recognized during that time frame that the state-based unemployment insurance system couldn't handle the 750. Try throwing 6 million on it, right? So if we did not get an economic plan out there very quickly, you were going to have tens of millions of layoffs with computer systems that could not handle it. The backup is manual input, except the state offices are closed. So where are you at? Breadlines? During an airborne pandemic, can we start talking about mass casualties? This was unacceptable, right? And so the decision was made very quickly by congressional leadership and administration leadership that we were going to fill the gap. And so we looked at what's the scale of the reduction in economic activity that's going to take place. That ought to essentially mimic the scale of the CARES Act. And so if you think about that $2 trillion, that was again, it's a $28 trillion economy. So a $2 trillion, if you're shutting down for a month, that's, you're in the $2 trillion range. So that's about the scale of the kind of intervention that you're going to need, the kind of income level replacement that you're going to need. So that's where the scale of it came from, and I think we scaled it about right. We essentially replaced all of the personal income. You didn't see very much inflation as a result of it. Households were able to handle the temporary shutdowns because we were talking about 2 weeks, 4 weeks to slower the spread. That was the objective at the time.
So
let me contrast that now, because I only answered half your question.
Quick question.
Yes.
So basically the household money supply that they have in their cash and checking accounts would go way down because if everybody's laid off, and so the CARES Act restored that.
Right. So if you think about the way that people pay for things, right? It's income, it's savings, and it's credit, right? And so and for the most part, it's income, right? So if you're massively taking away income and there's no government support program to supplement the income, then you're on savings and credit. So are we going to have a run on the banks? Are we going to have a run on financial markets? And so that's why Treasury worked very closely with the Federal Reserve to make sure that we had adequate liquidity in financial markets so that if there was a run on particular investments such that people needed to sell them quickly in order to pay for things, they could get access to them. We were very much monitoring the banks to make sure there weren't bank runs, working with the Fed to make sure that if there were discount rate issues, that banks could access liquidity if there were runs. All of that, we were doing all of that simultaneously. And then the third thing is credit. But you wanted to make sure that people continued to have access to credit, but not everybody does. And the people that are going to be most impacted by these shutdowns were the people that have the least amount of savings and the least amount of credit, which means we have got to get assistance out to them very quickly, which is why timeliness, the speed with which we could get an intervention implemented was the key priority of the Secretary and the President. Now, you asked me to contrast that with the American Rescue Plan, which was also $2 trillion. Mm-hmm. That was done in March of 2021. Now remember, by March, so at the depths of the pandemic, the unemployment rate hit about 14%, if I recall correctly. Okay? By the time January of 2021 rolled around and I was heading back to the university, if I recall, the unemployment rate was below 7, I think it was in the 6s. right? Economic output had about 90% recovered. So by the second quarter of 2021, GDP had recovered to pre-pandemic levels. So even though we had a 28% annualized reduction in economic output in the second quarter of 2020, we had a 32% rebound in the third quarter, and we had another 5 or 6% growth in the fourth quarter. So we had largely rebounded. Oh, and by the way, we had 3 vaccines coming online, right? So to the extent that there were still a number of people outside of the labor force because they were worried about getting in contact, primarily because they're older or have pre-existing conditions or some kind of comorbidity, the vaccines were coming online and those folks were being prioritized. So the ground was set for the continuation of the V-shaped recovery that we started in the second half. That's not when you throw an additional $2 trillion into an economy that's already recovering. Because remember, the other thing that happened was that because we had full income replacement during the pandemic, people were making, the amount of money coming in was about the same, but they weren't consuming at the same levels during the pandemic. You weren't going on vacation, you weren't going to restaurants, you weren't going to theaters, and so the savings rate went from, so the percentage of income that the average household saves went from about 6% to 17%. So there was this massive buildup in savings. People were sick of being stuck inside. Things were reopening. There was already the desire to go out and re-engage in the economy, and there was all of this accumulated savings that had happened because, again, income stayed the same, consumption fell, which meant a stock of money had built up in people's checking and savings accounts. The last thing you needed to do was take all of that demand that was already there in the beginning of 2021 and throw $2 trillion more on top of it. So it's not a coincidence that, unlike the response to the CARES Act, where we didn't get any inflation that resulted from it because it was largely replacing foregone income, if now you're throwing gasoline on a fire that's already been ignited from all of this pent-up demand, you're going to get inflation. And that's why there's just such stark differences between the economic impact of our $2 trillion, the CARES Act, versus the $2 trillion that we saw in March of 21.
Interesting. Yeah. Okay. So you and I have talked a lot about the Paycheck Protection Program that you were in charge of, and there's some just interesting background about how that happened, how fast that had to happen, and the constraints that you faced when you're trying to put it on. So
right.
Can you just tell us a little bit about the Paycheck Protection Program, which you headed?
Right. So one of the reasons I think PPP worked so well, that I think is really underappreciated, is because it was a PPP. And by that I mean a public-private partnership. There are capacities that exist at the federal government. There are capacities that exist in the private sector. The federal government does not have the means to overnight get hundreds of billions of dollars out to workers that are potentially subject to layoff, right? So if you think about, we did get stimulus checks out there, but it took, it took more than a month to get that money flowing, whereas the secretary said, well, if we wait a month, if you're doing 6 million unemployment claims a week, and we wait a month, that's an additional 25 to 30 million Americans that are going to be on unemployment. And again, the system can't handle that. You've got to get it out really quickly. There is no existing infrastructure and architecture in the federal government to do that. And instead, where is it? It's the banking sector. The banking sector has the plumbing to get that kind of money out there with that kind of speed. And so what do you need to do? You need to take a product that banks do, loans, and turn it into a grant, which is what we were doing. Well, how do you do that? You call it a forgivable loan. So we extend it as a loan, and then provided that you demonstrate that you use the money for the purposes that Congress intended, which I'll get to in a minute, that loan becomes forgiven. And so, you bring your documentation back to your lender and say, here's how I spent the money in conformity with what the law requires. And then the bank, submit that to the federal government, showing that indeed, or asserting, so it was the responsibility of the borrower to demonstrate to the lender that they had used it for the purpose. The lender would then tell the federal government, yes, they did, and then the federal government had the authority to audit both the financial institution and the borrower to make sure that it actually was done. And again, Treasury very much took kind of Treasury's standard approach on it. So Treasury partnered with the Small Business Administration to do it because they are the ones that generally do loans to small businesses, and PPP was targeted at small businesses. But how does Treasury in general ensure compliance? We do it through audits, right? Treasury is home of the IRS, right? And so people fill out their taxes. You don't submit all of your receipts to the IRS. You hold them available should you get audited, and then you have some kind of algorithm that goes and looks for kind of weird submissions, right? So you audit just a small fraction of them for compliance, but then you also use algorithms and analytics to figure out where do there seem to be some anomalies in some of these, and those are the ones that we're going to more likely audit. And so we put together but the whole idea was, in order to get the money out there quickly, we're going to have a minimalist application process. So we're going to, you're only going to be able to get one. So we're going to make sure that every tax ID number only gets one. It's incumbent on the banks to verify that this is the amount of your payroll expense that you have. And then they're going to lend the money, standard loan doc. And then if you bring back your receipts, they take a quick survey of them. Yes, it seems to add up. They certify it to the Small Business Administration. And what happens is SBA then pays the bank for that loan instead of the borrower paying it back. So that was the program that we set up, and essentially it's turn a lending platform into a grant platform. And so I have given talks like this to various banking administrators, and I somewhat in jest but somewhat seriously say, thank you for being our grant writers, essentially implement our grant administrators. Because that's what you got to do. You got to think about what are the to kind of use a military analogy. You don't go to war with the military you want. You go to war with the military you have. And so you got to look at what are the assets that you have. How can we most effectively redeploy them to fit the needs of this particular situation? And the banking system was the way to go. And so we generated it. Now, in terms of scale, to give you an idea, Congress allocated $350 billion in the CARES Act for the Paycheck Protection Program. And President Trump signed the CARES Act at about 5 o'clock on Friday, March 27th, at 5 o'clock in the afternoon. And the secretary had already told the press that we will have that program up and running within a week. Okay? In fact, I'll never forget the day he came in to my senior leadership team and me, and he said, I just told the press the most outrageous thing that a Treasury Secretary has ever said in the history of our nation, and that is that we're going to get a $350 billion program up and running in a week, and the people in this room are going to do it. And so we put out the term sheet over the weekend, we put out the borrower application on Monday, we put out the lender application on Tuesday, we put out the interim final rule at about 7 o'clock at night on Thursday, and we oversaw the first approval of the first loan Friday morning at around 4 a.m. Money started flowing. The secretary spent the day tweeting about how much money was already flowing. And within 2 weeks, we exhausted our $350 billion appropriation. And to put that number in context, we did 14 years worth of SBA lending in 14 days. So we went back to Congress. We knew that they underappropriated it because Congress does as Congress does. They expanded the program, they expanded eligibility, and so we had an indication. I had told the secretary early on that as crafted, the program was probably going to run $600 billion. And so when we started seeing the demand that we anticipated, we went back to Congress at about day 5 of the program. Again, we exhausted the appropriation in 14 days. At about day 5, we went back to Congress and said, we estimate that we're going to need another $250 billion. They ultimately gave us 310, but it took a little time because Congress did have to come back, even though they were on hiatus, right? We were under shutdown orders, so it did take a little time for them to come back and do their thing. So the PPP window was closed from April 17th to April 27th, and then we did another $175 billion worth of lending between April 27th and kind of end of June, but by the time the program closed in 2020, we had done $525 billion in lending.
So you had $75 billion left over.
Well, so we were ultimately given $660.
Oh.
So yeah, we asked for 250, they gave us 310. So we ended up with 660 of lending authority, we did 525.
Oh,
So we had about 135 billion left over. And of course, in Congress's infinite wisdom, they did not return that to the taxpayer or pay down debt with it. They spent it later.
okay, so what were some of the real challenges that you had when, I mean, it sounds like a lot. I mean, 14 years of loans in 14 days. My goodness, and with the system that you had in place?
Right, so again, you're building this on a computer system that was
Right,
built to
COBOL-based.
handle 14 years of lending in 14 years, right? And so, you know, one of the things that we had to do was we stripped down that application to its bare minimum, right? So if you have a computer system that you're going to just, by orders of magnitude, increase the throughput on, right?
Right.
Then you've got to strip down the loan application to the barest minimum of information. And so we regularly, when we were building out that loan application, we would ask the question, is this piece of information absolutely necessary in order to originate a loan, or can we get it when we do the forgiveness process? Because forgiveness is going to come a couple of months later. We're going to have more time to build out. We can, you know, over a 10-week, 3-month, 6-month process, we can bring in additional IT servers. We can bring in additional capacity. We can work with AWS or Microsoft to put this stuff on the cloud. We can't do it in a week, right? So we're going to strip it down, bare minimum. What do we absolutely need? Recognizing, unfortunately, that you may facilitate a little bit of fraud in the process. But if you give me a question and I defend it to this day, how much fraud am I willing to give up in order to have this program up and running in a week instead of in a couple of months? And we ended up with, according to SBA, and this is the Biden SBA numbers, we're at about a 1% fraud rate on PPP. I can live with that.
Only
8 billion.
1%.
Well, again, the media loves to go with bigger numbers. So what the SBA Inspector General said is there's $200 billion in potential fraud. Now let's define potential fraud. There is one error in the database associated with that loan. I fully acknowledge that there are a bunch of what we call fat finger loans in that database, where you brought everybody from the bank CEO to bank tellers who had never been on the E-Tran system, inputting loans into a system they had never been in before, and they miskeyed some numbers in there. I fully acknowledge that there are errors in that database, which the IG then goes and evaluates. Okay? And so they say if there's a single error in the database, then that is a potentially fraudulent loan. But SBA says, now we then applied more analytics to it, we then did some investigation on these things, and in terms of actual fraud that we are, think that we should pursue and is being investigated, the number is $8 billion. It is not $200 billion.
So are you saying that during this process, if I hear you right, I might have misunderstood you, but I could go and apply for a PPP with this stripped down
Loan application.
and then you would not forgive my loan because when you go through the forgiveness program, you find out that, wait a minute, he had the money all along. He didn't, somehow that was...
So to the extent that the requirements of the program were violated, the loan may not be forgiven.
Okay.
Now,
Yeah.
the way you phrased the question, though, was, well, they had money. That, unfortunately, so we had a very thorough discussion when we were negotiating the CARES Act. In fact, to the extent that anybody is interested, there is a June 2020 hearing of the Senate Small Business Committee. It was the first time that the Treasury Secretary had ever testified to the Senate Small Business Committee, because they're not usually the committee of jurisdiction for Treasury. We go to Senate Finance, we go to Senate Banking, we go to Senate Appropriations, but the Small Business Committee runs the Small Business Administration. But PPP was a joint effort by Treasury and the Small Business Administration, so the Secretary was testifying to them. And Senator Romney brought up an issue about, well, there are people who got PPP loans who didn't need it. Now, Senator Romney was not part of the working group that put together PPP. There were 4 senators, essentially, and this is public knowledge. It was Chairman Rubio, Ranking Member Cardin, Senator Collins, and Senator Shaheen were the 4 people that we worked with on the Senate Small Business Committee to negotiate PPP. And there was a discussion of, should we have a revenue test? So should your PPP loan not be forgiven if you had no revenue hit? Okay?
Okay.
And ultimately, the policy decision was made by the Senate, by that committee, to not have a revenue test. And there essentially were two main reasons for it. Number one, you did not want to deter businesses from adapting. Right? So imagine you've got two businesses next to each other. One of them adapts to meet the needs of their local community. The other one doesn't. The one that adapts, therefore, has no revenue hit. The one that does not adapt has a revenue hit. The one that adapts serves the needs, they get their loan forgiven. Sorry, the one that adapts meets the needs does not get their loan forgiven. The one that does nothing gets their loan forgiven. So is that what you want the federal government incentivizing? Do you want them encouraging to not evolve to meet the needs of the pandemic? And so that was one issue. The second piece was when you're talking about the borrowers that we're talking about, okay, it's not just like a 300-person manufacturing firm that has a pretty sophisticated senior leadership team. You know, we're talking about somebody who runs a gardening service and has 5 employees, right? We're talking about somebody who has 3 employees running a dry cleaner. We are talking about people who may not have high school diplomas. And those are probably the people most in need of the program and the least sophisticated to understand the nuance of the program. And so if you all of a sudden go to them and say, if on the one hand so what we went with is, if you get this loan and you pay your employees, you will be forgiven, end of story. Period, no exclusion. No complication, very easy to understand. If you all of a sudden say to them, well, there might be conditions under which that won't be forgiven, do they still take out the loan? Do they still pay their employees? If the answer is no, if that uncertainty causes them to not take out the loan, well, then where are their employees going? They're going on the unemployment rolls. Well, but isn't the objective to not get them on unemployment in the first place? So do you actually cause the very thing your program's trying to mitigate because you're putting in place a complication that the people most in need of the program are going to be the least likely to understand? And so we chose not to put in a revenue test.
Okay.
But so what that meant is that businesses that ended up having no revenue impact ended up getting their loans forgiven. And what's interesting is we didn't know at the front end which businesses were going to do just fine. I mean, there were a few. Like, okay, you know, I will say on video, my idiot cousin who sells respirators, I'm still to this day pissed that you got a PPP loan forgiven. You did not meet the economic needs certification. Okay.
Yeah. So we go live to tape, so
I
we
understand.
don't edit anything anyway.
But like, let me give you an example. Stay-at-home orders. Here's a business that you think might be negatively impacted. Marinas.
Yeah, sure.
Marinas had their best performance ever because all of a sudden we figured out, oh, going boating is a really good social distancing activity, and so you could not buy a boat in the summer of 2020. They had their best year ever. But did we know that going into the pandemic? No. So did marinas apply? When marinas applied for PPP loans and said, yes, I foresee that I have an economic need from this, is it entirely rational for the owner of a marina in March or April of 2020 to forecast that they might need to shut down their business? Absolutely. Well, then that loan is completely appropriate.
Okay. That's just fascinating details. I mean, the speed with which that program was put in place is just astonishing. So if we can, I'm sure there will be some more questions in the Q&A on those issues, but let's just shift gears ever so slightly, or maybe even quite a bit, to of interest to our listeners, many of our listeners, especially the Consumers Research crowd, is that let's talk a little bit about the Consumer Financial Protection Bureau, the CFPB, and under the President Trump's term, it had a kind of a meandering leadership. It's 3 or so different directors come in, and so from your perspective, we can just use the CFPB as an example. There are other agencies too, but what is the, how do you think the leadership will process will change at agencies such as the CFPB?
Right, so I think you saw under President Trump, and you would see in a second term, that there really is a need to exert more political control over some of these departments and agencies, that sometimes the people inside them try to engage in activities that Congress actually has not authorized, that they stretch their mandate beyond what has been approved by Congress. And I think you're really going to see a difference in the second term because the Supreme Court has come in with so there was a case that was decided in the last term that overturned what was known as the Chevron doctrine. And so prior to that, departments and agencies could implement rules in any way they felt was in the least bit consistent with the statute. So what the court now says is, so imagine for a moment you have a statute that has some kind of ambiguity to it, and there are potentially 6 different ways that you could interpret that statute. What the Supreme Court had essentially said previously was, well, we're going to defer to that department or agency to pick which of the 6 they want to do. We're going to defer to their expertise. What the Supreme Court has now said is, no, you need to go with the one that is most consistent with the legislative intent. So it's no longer, if there's ambiguity, you need to go with, the court is now going to review whether or not you have gone with the implementation that is most likely consistent with congressional intent, not giving you the ability to stretch it to do what you wanted to do without congressional authority. And so I think you have seen a number, particularly at the independent agencies, they have gone rogue. They have gone and tried to greatly increase their mandate because unfortunately the way Washington works is, once you've got leadership of a department or agency, you want to expand your footprint. You want to increase the scope of what you have some authority over because, of course, you think that the world would be a better place if only it would operate the way you think it should operate. And so you stretch your mandate well beyond whatever was intended. And so that's why I think you saw under the Trump administration, there was very much a desire to put in place leadership into those positions and say, are we really actually operating within the scope of what Congress has authorized? Are we fulfilling the more narrow objective that was set for why this department or agency exists? Or are we going out and going well beyond the authorized mandate? And so that was, I think, the approach you saw. And under the Obama administration, I think you saw CFPB go well beyond its mandate. You saw them enter into things that Congress never intended them to go into. And so there was very much a desire to say, what is the core consumer financial protection mission? What products and services and activities are we therefore going to focus on that's narrowly within that activity rather than expanding to go after all of these other things for which Congress never provided authorization?
Okay. I know that in this room we have people who would say, let's just abolish the CFPB. Do you think that would ever happen, or what are your thoughts on the usefulness then of a well-functioning CFPB?
So I agree that there are needs for consumer protection in financial services. I don't want to say that there are no lenders out there that may be taking advantage of people or products out there that potentially have some detrimental consequences. So that said, the way that the CFPB is structured almost invites it to go well beyond its mission because unlike almost every independent agency has a budget that is set by Congress. It is annually appropriated. Okay? CFPB, the director submits a request to the Federal Reserve, and that's the amount of money that they get to spend. It is not approved by Congress. And so the result of it is, if they want to take their mission and they want to expand it and go in multiple other directions, normally Congress would step in and say, well, there are limits to how far you can go because we're only going to give you so much money and you've got scarce resources with which you've got to, and you still need to achieve these core objectives. With CFPB, if they just all of a sudden say we need more money, then they can ask the Fed to give them more money. And so at the very least, I would like to see the CFPB but under the appropriations process, the way that most independent agencies are provided budgets.
So that means they would have to go to Congress and ask for like their allowance to be approved.
Correct, and it also means that Congress would have more of a tool to rein them in if they start exceeding their mission, because you can hold people in front of an oversight committee meeting all you want. What that really means is that each member gets 5 minutes to be mad at them, but it's really hard to argue that it has much consequence. Whereas if you have control over their budget, you can sit there and say, if you don't stop doing these things, we're going to cut your budget. And that tool has been taken away by instead granting it to just merely a budget submission to the chairman of the Federal Reserve.
Got it, yeah. So of interest to, this is a question I ask all of our lead speakers, and because I'm a finance professor, I engage in research. I know a lot of friends and colleagues who engage in research, and can you tell us a little bit about how academics can help foster a good regulatory environment or do research that is useful for policymakers?
Yeah, absolutely. I mean, as chief economist, a lot of my role was to take the academic literature and project it onto policy issues that we were thinking about. So for instance, one of the things that came up while I was chief economist was a proposal to implement a financial transactions tax, right? So a tax every time there is a trade, right? Which essentially is the equivalent of increasing the bid-ask spread on trades, right?
Sure.
Well, so let me bring in an academic who does work on bid-ask spreads to talk about its impact on price discovery and on liquidity so that we can understand the economic implications of it, right? As I mentioned, one of the reasons that I was brought in is because I had done a lot of research prior to going to Treasury on some of the perverse incentives that were in our tax code that led to multinationals behaving the way they did and companies generating stockpiles of cash over in foreign subsidiaries, right? So there is academic literature that evaluates and examines some of the decision-making that happens by individuals, households, companies that maybe is not the intended consequence of a rule or a policy or a tax code component that we can learn from and modify. So unfortunately, I see that a lot of faculty members try to steer away from thinking about the policy implications. I tell academic audiences as much as they'll listen to me, to the extent that we are not just merely about talking to each other and that we actually want to have impact on society, we should think more, not less, about what are the implications of my work for practitioners and policymakers. And so, are you asking that academic question merely because you're intellectually curious about it, or because you think that it would play well in an academic journal? Or is it because you actually want to think about how we might improve our society, how we might better manage our economy and realize better outcomes for the American people?
Okay, that's really good. So actually at this time, I want to turn over to anybody in the audience. You have to put you on mic, this portable mic. I think Dean Graw had another. Oh, he does. Okay, so we want to make sure that to make it onto the live stream and the subsequent tape, you have to use a microphone to ask questions. So.
Anybody?
This is like a class.
It's right over here.
Right.
You got the first question.
Okay. I think you have to turn it on there on the rule.
So we have seen like growing
Okay.
balance.
You got to turn it on.
So we have observed that there is a growing outstanding balance in the credit card in the recent years.
Right.
So how do you see the economic policy is going to affect this situation in near future, especially given that the delinquency rate in the credit card balance was in the last year around 9%, and that to put that number into perspective, during 2008 global financial crisis, that number was above 10%, getting closer. So how do you see the
Yeah,
policy?
so let me back up and just, why are we in this situation? Okay, so remember before I said people pay for things three ways: income, savings, and credit. okay? And so what we have seen over the last 3.5 years is that wage increases did not keep up with price increases, right? And so we've had about 20% cumulative inflation, and we've had about 17% cumulative increase in wage growth in the last 3.5 years. And so, you know, people's wages are buying 3 to 4% less today than they were a few years ago, okay? So if your income is not keeping up with your increases in expenses, then you've got to find another way to pay for it. The second way you do it is that you go through savings. And so, as I said, during the pandemic, households built up a lot of savings. Savings rates today are not, you know, so remember, prior to the pandemic, they were at about 6. They went up to about 17 during the pandemic. They've been at 3 recently. And that 3 is an average. And so what you see is the top 20% of households have been doing fine. The bottom 80% of households are more in a 0 to negative savings position. So they have largely eaten through the savings that they accumulated during the pandemic, which leaves you source number 3, which is credit. And so you've seen credit card balances hit an all-time high as a result of wages not keeping up and savings being exhausted. Okay, so take record high credit card balances, put on top of it a higher interest rate environment, and again, if people couldn't fund their current consumption out of their income, then where is the money going to come from to pay a higher credit card debt balance, right? So if their current income is not paying for their current consumption and they're putting it on credit, well, the next month when that credit card bill comes due, they still have to pay for current consumption, but then they've now got a credit card balance tied on top of it at a higher interest rate. And so what's the natural result? Well, at some point, you're going to start hitting delinquencies. And so we've seen delinquencies starting to rise. The question that we've been asking is not if, but when are households going to reach a breaking point? They're going to have to pull back on consumption. And so this is the piece that surprised most economists, is that you would expect that when households reach a breaking point, they pull back on consumption. And yet again, if you look at the quarterly GDP numbers, we still have not seen that pullback in consumption that our models would have anticipated.
So related to this, would you talk a little bit more about the current state of the economy as well as the outlook beyond that? To your point, the
Sure.
models are predicting a somewhat unprecedented situation.
So the way that I look at the current economy is that there's really 2 economies simultaneously going on. So whether you look at the GDP numbers or you look at the employment numbers, there is the government-centric part of the economy, and then there's the private sector part of the economy, right? And so if you look at residential construction, if you look at manufacturing, if you look at mining, if you look at IT and business services, they've been flat. The ISM survey, so this is the Purchasing Manager survey that looks at manufacturing, it's been in recession territory, if I remember correctly, 23 of the last 24 months. So the parts of our economy that are usually entirely private sector driven seem to be flat, if not in recession. Whereas the parts of our economy that are largely government driven, so government itself, education, healthcare, social assistance, that's where the job growth has been. That's where you're seeing expansion, right? And so the question is, for how long can we run $2 trillion annual budget deficits generating government employment? You know, at some point, that house of cards is going to fail. So if you don't have private sector growth and all of the government-centric growth is driven by an unsustainable budget fiscal situation, that party's going to stop at some point. And so the question is, when is that going to happen? Another way to look at it is if you look at economic growth in nominal terms, I think it's on the, I think it's on the order of about $700 billion, right? But we added 1.7 trillion in debt this year. So we increased the production of the economy by $700 billion, but we increased the debt of the economy, of the government, by 1.7 trillion. That's usually bad math, right? And again, is not sustainable, right? if the economy is growing faster than government debt is growing, there's an argument to be made that it's sustainable. You don't have to balance the budget, but the debt to GDP ratio has to stabilize. If debt is growing significantly faster than the economy, then your debt to GDP ratio is rising. And that's the number that you worry about that puts us into a situation where lenders to the federal government at some point are going to say, the only way that the federal government can afford to pay me back the money that I lent them is by money printing. And if the only way that I'm going to get paid back is through funny money, then it doesn't matter what interest rate you pay me, I know it's going to be paid in funny money. And that's where you have what's called, that would be a bond market failure. And so if you listen to the guys at the Penn Wharton budget model, they say under the best case scenario that's in the next 20 years. So we have got to get our fiscal house in order. And the pending the ongoing retirement of the baby boom population is what's really fueling that.
I think around 2 questions about taxes.
Sure.
So there's a tax law change around 2017 and 18.
Yep, the Tax Cuts and Jobs Act.
That's right. So unify the tax bracket to 25 or 21%.
The corporate income tax rate was brought from 35 to 21, yes.
Yeah. So I think the commonly accepted view is that it reduced the corporate tax burdens, but actually it's not sure, I think. So the first question is if this really reduced the corporate tax burdens, because the effective tax rate, even though there are different tax brackets, the many corporate actually pay taxes way lesser than that regulatory extent. So and my second question is...
Let's do the first one first.
Yeah.
Okay. So there was a lot to unpack there, and I probably have to do some explanations of things. So there's the marginal tax rate, which is 21%. It was 35. And then you have what you said was the effective tax rate, which you can think about as an average, right? Okay, so you get, so as an economist, you get into issues of do people make decisions about the average or do people make decisions on the margin? And so, given that I do some R&D, given that I have purchased some capital equipment, there's a bunch of my income that's already exempt from taxation, right? So in order to stimulate economic activity, the tax code gives tax credits for research and development. It gives accelerated depreciation on purchases of new capital equipment. So that's going to reduce my effective tax rate. But it's still the case that the next thing I do is subject to the corporate income tax rate. So the next thing I do under the old tax regime would have been at 35%, whereas now the next thing I do is at 21%, right? And so if the next thing that I do is now got a lower tax rate associated with it, if I'm going to be able to keep more of it, then I'm probably going to do more of it, right? So I think there's some recent evidence pretty clearly. So there's an Eric Zwick working paper. It's an NBER working paper. Him and co-authors have access to actual IRS data that shows that we did get a very sizable increase in capital investment after the Tax Cuts and Jobs Act. So I don't think it's questionable whether or not we got more economic activity. I would remind you also that 2 of the 3, like in the 2017 to 2019 period, 2 of those 3 years, we did get back to 3% economic growth. We saw median household income increase $7,000 on an after-inflation basis. So it does seem like we had a pretty good economic outcome following the Tax Cuts and Jobs Act. I think it's important to also understand that 2 more things that we did in that bill. Number 1, we for the first time taxed worldwide income. So there used to be this really perverse incentive that if you operate abroad and then you keep the money abroad, you avoid US corporate income tax, whereas now we have subjected it to immediate taxation. And so instead of it being more like 5% if I do my business in Ireland versus 35% if I do my business in the United States, we took it to, it's now I think 14% if you do it in Ireland because of the immediate taxation on the differential versus 21 if you do it in the United States. So that's going to stimulate more economic activity here in the United States. The other thing I would point to is that, remember, a lot of small businesses and partnerships and S-corps are pass-throughs. They don't pay taxes at the corporate income tax level. And so in order to assist small and medium-sized enterprises, we brought down the marginal rate that people are subject to on their personal income, pass-through income, and provided a 20% pass-through deduction. So all of those things were meant to improve the incentives to engage in investment and economic growth here in the United States. And I thought that the academic literature, at least the portions that I've seen and reviewed, and so if you go to our webpage at americafirstpolicy.com, we have put out 3 different review articles on what the academic literature has been saying on the Tax Cuts and Jobs Act, and you can see our compilation of the academic literature.
Sounds good. Thank you.
Second question.
Right. So I think we are talking about the tax cut actually do cut the tax burden for people, and now people are now have more money. Would you think that will actually affect the credit markets, people's consuming behavior?
Yeah. So we anticipate that back in 2018, when that Tax Cuts and Jobs Act, so it was passed in December of 2017, so people really started to see the benefits of it in 2018. That's when you would see. That's when we saw the increases in household income. So as I mentioned in my last response, between 2016 and 2019, I think we saw a $7,000 increase in after inflation household income. And a lot of that is, in our view, the result of the deregulation that we talked about before and the impact of the Tax Cuts and Jobs Act. And so many of those things are expiring. And so there is very much concern that if those provisions expire in 2025, that we would potentially see some negative impacts for the economy from it.
Thank you.
And I took my phone out because my 14-year-old is texting me and it was vibrating against the microphone.
Oh, here's a question in the back. Oh, over. Oh.
Line questions actually, but I'm going to ask a question for myself first.
Go for it.
You mentioned that competition was the biggest regulator or the best regulator.
Yeah.
In the wake of the dot-com bubble, we've seen massive amounts of concentration in technology, post-Dodd-Frank, lots of concentration, market concentration or mergers, acquisitions, whatever you want to call it, in the banking sector. One of the things that the Trump administration did was kind of move away from maybe the traditional libertarian view of big is fine, big is good. And we've seen some of that continue in the Biden administration, especially at the FTC and the DOJ. Do you think that's something that's here to stay? Is that going to continue? Do we have a market concentration problem still, and do we need to rethink things?
So let me start with banking since you specifically mentioned it. So it is true that if you go back, I believe, to the 90s, we had 14,000 banks in this nation, and today we're fewer than 5,000. So you might sit there, your first response may very well be, she's now calling me for the 3rd time. Your first response may be that if you go from 14,000 banks down to 5,000 banks, that's a reduction in competition. However, at the same time, the geographic scope that a given bank serves has increased. So conditional on being in a particular town, there are more banks available to you than previously. So if you measure it nationally, it looks like there's been concentration. But if you measure it locally, there's been an increase. I would say the same thing in retail. So, you, for instance, have seen Macy's consolidate a lot of the department stores nationwide, right? So when Tom and I lived in St. Louis, there was Famous Bar. If you lived in Chicago, you had Marshall Fields. All of and in the Maryland area, it was a store called Hex. If you look at all of those locations today, they are all Macy's, okay? Now, Macy's didn't previously sell in St. Louis. They didn't previously sell in Chicago. So again, there's consolidation at the national level, but at the local level, there's still the same number of department stores that are competing with each other. And if through that consolidation, you have more efficient distribution centers, you have more bargaining power when negotiating with suppliers, you can potentially get more efficiency without generating consumer harm. In fact, this is kind of the consumer welfare standard that people like Robert Bork, when he was an associate justice, when he was a Circuit Court of Appeals judge, very much is thought to be one of the people who really put in place a lot of the jurisprudence along these lines, recognizing that through size, if you achieve economies of scale, you can actually improve consumer welfare rather than mergers and acquisitions solely being exercised as a monopoly power, right? So I don't want to take away, I don't think that we are looking at all to take away the consumer welfare standard. That said, the consumer welfare standard should not be merely limited to price. You can do consumer harm, you can reduce consumer welfare, not by competing on price, but say reducing the quality of the product, right? And so one of my colleagues and I at Treasury, since leaving the administration, we wrote a piece in the Wall Street Journal where we said the consumer welfare standard should be expanded to recognize that there are these other parts of welfare. And if what you have is, say, a tech company reduce the product's quality, then that is just as much of a monopoly power exercise as using it to maintain quality but raise price, right? And so perhaps we should widen the mechanism. And so if you engage in censorship on your platform, that may not alter price of somebody using your platform, but it reduces the welfare that consumers realize from the platform. So all of those are things that we need to take into account.
Okay, so there were some online
So
questions?
the online question that I'll ask first.
Just one second. This is the second kid now calling me. What is the issue? Okay. My 14-year-old and my 18-year-old are dress shopping, and they're sending me pictures and want to FaceTime to show me what dresses look like. It's like, girls, I'm busy. Sorry, we're going to edit that out. Go for it.
No, we're live to tape.
So, you before you went into the Treasury, you focused more on traditional research.
Yeah.
Has your research changed since you went to Treasury and have come back out? And what does that look like? What's the difference?
Yeah, so first is my more traditional academic research is much more policy oriented. So it is less asking, I used to primarily think about my audience being like CFOs and corporate risk managers and treasurers. And now I'm thinking much more about my audience being policymakers because I am more in the policy space. So it is more, what did the policy get right? What did the policy get wrong? As opposed to, what does this tell us about the decision-making activities of corporate financial decision makers? So that piece has shifted. The other piece is, because my objective now more is to change policy, I do a lot more of like research that you would call more white papers, that the audience is not an academic audience, the audience is policymakers and their staff. And so it's taking other people's academic research and saying, if I project the results of that academic research onto the policy proposal that's under consideration, here is therefore how you might think about some of the consequences of that policy proposal. But that's not what an academic journal wants. That's not something you write for purposes of getting published in the Journal of Finance. That's something that you then send out through think tanks to members of Congress and their staff in order to influence the way that committees are crafting legislation in the hearings that they're holding.
And I'm just going to add my own follow-on to this because it was an interesting conversation earlier. Is there a difference in the turnaround time for these different products?
Yeah, so I'll cite one of my predecessors at Treasury who did a podcast very recently, and he said, the biggest difference is, and so to give credit, this is Richard Clarita did a podcast. Richard Clarita had been Assistant Secretary for Economic Policy at Treasury during the George W. Bush administration, went on to become Vice Chairman of the Federal Reserve. He's an NYU professor. He was quoted in a recent podcast that was done for the Hoover Institute that said, when you're advising policymakers, you want to get it 90% right in weeks. whereas the standard in academia is 100% right, but it's going to take you 3 to 5 years, or some, I'm paraphrasing, it's something to that effect. But like for policymakers, that extra 3 years in order to get that final 10% often isn't worth it, right? You got to get kind of close enough because, like I said, during COVID, I didn't have time to get PP. I was given a week. And so are there things in retrospect, or had we been given more time we might have done differently? Absolutely. I didn't have it. And so, we were focused on doing the best we could in a week because that was the time frame the American people wanted. That's not the time frame that journals operate under. Dean.
So just keeping along the same avenue, one of the things that I really enjoy about this particular Lead Speaker Series is we do get a chance to have these conversations at the crossroads and engage academics with policymakers and others. I'm curious, to what extent in your time in Washington have you seen others across Washington lean on the academic community? It's actually refreshing to hear that you're actually you've cited some research, you've cited some papers, you've got an academic background. Are you a unicorn in Washington, or do you see your colleagues who are into policymaking and making some of these decisions, are they also leaning on some of the research that's been done in academia?
Right, so great question. There are a few positions that have traditionally been held by academics. So I am by no means the first academic to have been Assistant Secretary for Economic Policy. As I mentioned, NYU Professor Richard Clarita held it. Jan Eberly, who is a finance professor at Northwestern, was one of my predecessors as well at Treasury. If you look at the chairman of the Council of Economic Advisors and many of the people who serve at the CEA, those often are people who come from academia. As I said, the chief economist of the Securities and Exchange Commission is often an academic. So there are these roles that have traditionally sought out where the department or agency has sought out an academic to bring that perspective in. But we can do more of it. And this is where I'd like to see academic departments, academic units who are doing work that has policy implication. Are those departments or those universities rewarding faculty for not just the journal publication, but are they rewarding them for the white paper? Are they rewarding them for the congressional testimony? Are they rewarding them for the media hit that then brings attention to the role that academics can play in being a part of the conversation? Because too many academics and too many academic departments and institutions reward insularity. When you're entirely evaluated based on what other academics think of you, and there is no kind of attention or metric paid to the external impact of your work, then again, I'm pretty sure there have been countless number of Nobel economics prizes given to you, and you get what you incentivize. And so when all you do is reward activity that is insular to academia, it's no wonder then when we have a financial crisis or we have an economic challenge that the academic community is not called on because they have not demonstrated an interest or willingness to participate in it. Whereas if we would change the incentives at academic institutions so that they were actually more integrated into policymaking, I think that there is a receptivity on the part of members of Congress. But if you have an academic that says, why doesn't Congress listen to me? I've been writing about this for 15 years. Well, are you writing it for an academic audience or are you writing it for a member? If you hand a member of Congress or their staff a 100-page research paper with 14 different appendices, and somewhere in there you make some kind of relevant point about a piece of legislation, it will be completely ignored. Whereas if you write a white paper that's like 5 pages on, like, here's the policy issue, here's what the academic literature, including my own, says, here's how you might improve the policy. Will the member look at it? Probably not. Will the staff? Yes. Because it's crafted for them. It legitimizes their role in the policymaking sphere. But this idea that entirely too many academics take up, well, they ought to come to me because I'm the subject matter expert. No.
I think we might have time for one more question. My watch says we have about 45 seconds to go before we hit 3 o'clock. So anybody, any last? Yes, you need a microphone. Make sure you turn it on. Okay, wonderful.
I'm interested in quantitative easing mechanism. I read that this is a unique, specific mechanism. It is possible to cover the budget deficit borrowing from Federal Reserve System, and it is not accompanied by inflation, the rising of inflation rate. Can you please give some explanations? What is the difference of this process, especially in the United States compared to other countries, and what periods this policy was more aggressive?
Okay, so quantitative easing, I view it as essentially monetizing the debt. It's essentially printing more money, whether or not that money is in circulation or it's held by the Federal Reserve in a bigger balance sheet. There is still a recognition by financial markets that their claims have been reduced in value, right? That they, the claims against the future that they have are being devalued by the fact that there is just more money out there that has been printed. And we have seen countries monetize their debt before, and it does not work out well. And so we're starting to see that here in the United States. Prior to the pandemic, prior to this massive engagement in quantitative easing, the Federal Reserve paid somewhere between $80 and $100 billion a year in dividends back to the federal government. So to put that number in fiscal year 2022, if I recall, that number was about $120 billion. The Federal Reserve being the monopoly printer of money, right? So if you can put a $100 bill out in circulation and it costs you 50 cents to make it, you have made $99.50. That's called seniorage. And given that the Federal Reserve is the monopoly provider of money supply in our economy, they can make a lot of money at it. And in fiscal year 2022, they made $120 billion doing it. Now, what did they do? Well, they started buying up the debt during the pandemic in order to facilitate all of the federal spending that was going on. And if you recall, interest rates were really low. Like 10-year interest rates were at 0.6%, 30 years were as low as 1.25%. That's nuts that interest rates are that low. If you have a forecasted inflation environment of 2% and you have somebody receiving 0.6% interest income, their money is being devalued 1.4% a year for each of the next 10 years. Like that, I can't come up with an economic model that says you should have an equilibrium 10-year interest rate of 0.6% in a 2% expected inflation environment. And yet we did. And so the Fed went out there and was part of those who bought 10-year securities with 0.6% yields on them. Well, where are interest rates today? What's the Federal Reserve paying on excess reserves? 4.5%. Where are we at? We're at 4.5 right now, aren't we? Okay, so my bonds that I have on the Fed's balance sheet, they're earning 0.6%, but my deposits, which are the reserves that the banks have on deposit with me, I'm paying them 4. My math says I'm losing 3.4% on that. And that was the effect of quantitative easing, is because the Federal Reserve went beyond its normal role of just providing money supply and overnight interest rates to getting into buying 10-year securities because they wanted to manipulate the 10-year interest rate. And so as a result, how much seniorage, what was the dividend from the Federal Reserve back to the Treasury in fiscal year 2023? Remember, the baseline is $120 billion in fiscal 22. Answer, $500 million. That's right, a more than 99% reduction in seniorage income to the federal Treasury. And Treasury has this Congressional Budget Office has estimated that those dividends will not restart until 2029 because the Fed is sitting on hundreds of billions of dollars in losses from quantitative easing. So no, I'm not a fan.
Well, okay, so in our Lee Speaker Series tradition, we start on time and we end on time, and I declare it is 3 o'clock Central Time.
Thank you, Tom.
Thank you, Mike.